and we take up the next reading, which is the backtesting value at risk. So in the last 3 readings, we spoke about value at risk. We spoke about expected shortfall, parametric approaches, non-parametric approaches, surrogate density function. We spoke about the weightage of the for the historical simulation method and so on and so forth, extreme values as well. Here we're talking about the back testing. Like you calculated your VaR. How do you know whether your VaR is within the limits? And as per the regulators, what they've mentioned, how is it that your VaR is not exceeding a lot, not, it's not even exceeding once. So backtesting VaR is very important, and it comes in really handy to understand this particular thing. Backtesting is a verification that actual losses are consistent with the projected losses. Backtesting compares the history of VaR to the VaR forecast to actual realized return. So what I forecasted, okay, this is going to be my VaR, and what actually happened, I'm just comparing it. That's what backtesting is all about. The number of observations falling outside VaR should be in line with the confidence level. If I said that, okay, 99% of the time, it's not going to go above. So within 99% of the time, it should stay within that level. 1%, yes, it can. So that's okay. That was pretty much expected. That's what the thought process is. And the number of exceedance means the VaR is going above your expected VaR. That's what we can say. Is also known as number of exceptions. If you have too many exceptions, like your VaR is going up, tomorrow also it went up, that means your model is not good. It's underestimating the risk. But if there are only few exceptions, the VaR is not breached, not at all, that's an inefficient use of capital across units. You've put in lot of capital, you've put in, you've not done the job well, wherein you're not even taking risk and delivering returns to your shareholders. That is what the thing is. So it has to be in line with what is expected. Now, what are the significant difficulties that you can have in backtesting a VaR model? First off, understand VaR that we calculate, they are based on a static portfolios. Like we are assuming, okay, the TCS, the returns for the last 1 year, that's a static. But tomorrow it's going to be different. Maybe after 1 year, it's going to be different. But real portfolios change constantly due to price shifts and trading. So this disparity complicates the backtesting process. VaR models often exclude various risk factors like transaction bid-ask cost. It does not include that. Intraday changes to the positions of the portfolio. It does not include that. So that affects the accuracy, right? When you calculate the accuracy of backtesting, VaR will not do that. So how can you check the accuracy of backtesting? That's another difficulty in backtesting a VaR model. Using short time frames for backtesting. So when you use typically short time frame, like a week or so, you will not have major things to understand whether your VaR has been exceeded or not. Give yourself a little bit of time, increase the time length so that you can note down the exceptions over a period of time. Okay, so that's what the thing is. Using the short time frames for backtesting, like daily holding periods, can help mitigate some of the issues caused by omitted factors. When you use it for a daily, the reason for that is very simple. Because in a specific day, if there is a lot of VaR that has been exceeded in a specific day, then that means you can tackle that particular problem right then and there and not having to wait for a longer period of time. And you can also have another parameter which is known as the VaR exceedance clustering. That means your VaR exceeding is clustered around that particular period. So you can just catch hold of that and you can work upon that. The backtesting sample may not fully represent the true risk. So when you take out the sample to backtest, that may not represent true risk. So that can again become a challenge, making it essential to determine an acceptable level of exception. So you really don't know what is the acceptable level of exceptions. Backtesting involves comparing actual returns with the hypothetical returns as well. So it involves that simulate the VaR based on static portfolio. Again, the same thing. When hypothetical returns fail in backtesting, it may be necessary to adjust the VaR modeling. So if there is, the backtesting has been failed, the returns are failed in that, it may be necessary to adjust the VaR modeling methodology to enhance the accuracy and risk assessment. That means change the VaR models if regularly there has been a lot of exceedance that you are seeing here. So these are the challenges that you have it here. Let's talk about failure rates now. So failure rates, it's an unbiased measure of the number of exceptions as a proportion of number of samples is called a failure rate. I'll tell you, it's a very simple thing. You look at the number of exceptions, like within, let's say, 12 months, what is the number of exceptions divided by the number of data samples that you have? Time. N divided by T. Simple. And you get a failure rate. Okay. So that's what you have it. You just number of exceptions divided by the sample, you get a failure rate. What does it tell you? What is the use of failure rate? Well, the usage is tremendous. First off, if I say that, I've brought this example, pay attention here. I'm saying 99% confidence over 252 days, my VaR will not go up. That means 99% confidence, 250 days, 1% chance it can go up, right? So 1% of this will be 2.5. So 2.5 days or approximately 3 days, it can go up. And if it goes up, I told you already it's going to go up, right? So 2.5 or 3 days was pretty much acceptable level of, exceedance. But it happened on 6 days. 6 times it happened rather than 3 times. Now calculate the failure rate. So what is this? The number of exceptions, 6. The time is 252. What is the percentage? 2.38. So what you said, 99% confidence, 1% there is a chance. That's a failure rate. And the failure rate is 2.38%. That means it exceeded more than what you claimed. That is the purpose of a failure rate. So that's all that you need to know for the failure rates. Okay, now let me tell you, there is a concept of number of exceptions. They follow a binomial probability distributions. If I talk about exceptions, like, okay, let's talk about today. Did we see an exception? Yes, no. It's a binomial. Tomorrow, yes, no. Every single day is independent. Probability of success, probability failure is same. So ideally, number of exceptions follow a binomial probability distribution. But binomial is not so helpful here. What we do is we can approximate the binomial distribution by the normal distribution. So using the same binomial distribution, we can convert it into a normal distribution. And we get a formula to check whether the VaR model is biased or not. So we are using this kind of a Z-score formula to check what? To check the hypothesis that the VaR model is biased, unbiased. What is it? So the Z value is equal to the X minus this probability times T. So see, understand, it is using this Z value is using the same binomial thought process as well. So probability of success, 1 minus P is probability of failure. It is using the same thing, but as I said, it is converting that. So make a note of this. Okay, so Z is equal to the X minus the probability of success times the T, the time, the duration, the number of days. So as an example, In 1998, the daily revenue of JP Morgan fell short of the downside 95% VAR band on 20 days. So what is the number of exceptions? X is 20 minus more than 5% of the time. So 0.05 times this. So what was, understand, it's a very simple thing. 5% of the time I promised, but it happened 20 times. I told you 5% of the time. So that's the numerator, probability of success, 1 minus this times the t. Does it make sense? Yes. So we just plug in the numbers, we calculate this thing, and we got a value of 2.4, which is greater than the critical value. We are calculating a 95% VAR. So critical value is 1.96. Right? So we just find this thing, and if it is greater than the critical value, we reject the hypothesis that the VaR model is unbiased. So the hypothesis was VaR is unbiased. But if it is greater, the Z value is greater than the critical, then you reject this thing and you conclude that your VaR is not equal to unbiased, or you can say that it is biased. The VaR is bad. That is why the exceptions are rising, because of a faulty VaR model. That's what the usage of failure rates are, and this particular thing is. I hope you get an idea. All right, understanding the type 1 and type 2 error. Now, I think most of the people are confused with this type 1 and type 2 errors in the context of backtesting process. So type 1 and type 2 errors, I think this particular will help you out to understand what we are talking about in a much more visually appealing way. So type 1 and type 2 errors, users of VaR need to balance between type 1 against type 2 errors. Ideally, one would want to have a low type 1 error and then have a test that creates very low type 2 error rate as well. What is type 1 and type 2 error? Let's spend 5 minutes on this particular thing. So when you accept a correct model, it's good. It's an okay. You've done a decent job. And when you reject an incorrect model, that's a good thing. And that's known as a power of test. Okay, mathematically, we call this as a power of test. Well, this is where the bad thing happens. When you accept incorrect model, that's a type 2 error. You accepted incorrect model. That's very bad, because if you accept a VaR model that is incorrect, you're using a faulty VaR model. And just the example that we saw about the failure rates, there's the Z value. As you can notice, the Z value, 20 exceptions. VaR model was faulty, unbiased. So essentially, we can say that we are using an incorrect model. That's a type 2 error. And when you reject a correct model, that's a type 1 error. Now think from the point of view of a regulator. If you rejected a correct one, if you rejected a correct model, it's okay. You can create a new one. It's okay. Nothing bad will happen. I mean, ideally, you will have to work through it again, the modeling and everything. But again, yes. But just imagine from a regulator's point of view, if you are using incorrect model of VaR, that's a very, very bad thing as per the regulators. And that is why we say that ideally one would want to set a low type 1 error. Ideally, we want to have it low, but very low type 2 error rate, very low. This has to be even lower. So type 2 error is our major focus. We don't want to use incorrect model. We want to use an accurate model. Okay, so that's what we have it here. And there are some improvements that can be done to these type 1 and type 2 errors. And obviously, you want to have a high power of test. Okay, ideally, one would want a framework that has a very high power. That means rejecting incorrect. Whenever incorrect model comes in, reject it. Comes in, reject it. Ideally, that's what we want. Because if you reject incorrect, that's a good thing. That's a good thing, right? So you would want a framework that has a very high power or high probability of rejecting an incorrect model. Basically, power of test is all that you want. But the current framework, whatever the situation that you are in, it could be improved by choosing a lower VaR confidence level or increasing the number of data observations. When you have a lower VaR number, when you have a lower VaR confidence level, understand, now I'll just draw certain things. Okay. This is, let's say, 10% significance, and this is 90% confidence level. If this is, let's say, 20%, this is 80% confidence level. So as you can notice, if you have a lower VaR confidence level, when you have a moving from 90 to 80, when you're just lowering the confidence level, your overall, when you lower it, that means the, you would not accept, or basically there is a huge chance for rejecting the model, right? I mean, understand, if if there's a the alpha is 20%, that means there's a huge chance you will reject the model, and that's what you want. You want to reject incorrect model. So keep your confidence level low. That's going to be better. Understand this thing, okay? Try to understand what we are doing. Or by increasing the number of data observations. When you have a large sample observations, when you have a large data observations, obviously you'll try to have more data, and that's going to be beneficial for you to identify, to backtest, and you can, rectify any errors. So that's one thing. Another thing that has been suggested, and I want you to make a note of it, is that the horizon should be as short as possible in order to increase the number of observations and to mitigate the effect of changes in the portfolio. See, basically, when you're trying to find out whether the model is right or wrong, try to keep the horizon very short so that you can make some decisions, either accept or reject. Okay, either accept or reject. So the horizon should be as short as possible. Don't try to wait for an entire year and then see whether your VaR model is correct or not. Don't do that. Short and sweet. That's what the horizon should be. The confidence level should not be too high as well. As I said, again, it's a lower confidence level, not too high. That's one and the same thing. Because as I told you, basically, if you reject correct model, that's okay. That's okay. But if you accept incorrect model, that's not okay as per regulators. Not okay. So your major priority is type 2 error should be less, as less. And when the type 2 error will be there, when you reject more. And when would you reject more? Say, for example, if this is, let's say, this is my rejection region, and this is my acceptance region. Okay, acceptance region is, let's say, 40%, which is nothing but the confidence level. And this is a 60% rejection. So there is a high chance whatever test statistic you will use, it will fall in the rejection region and you will reject the model. Though you will make type 1 error, but at least you will be spared with using, not committing a type 2 error. Understanding? So this is critical. Try to understand it. Okay. So what is needed? Have a low confidence level. Try to have a low confidence level, and the horizon should be as short as possible. Increase the number of data. That's the few things just need to understand for the exam. Okay. Now, there's also within the backtesting, there's also a thing which is known as a QPEC backtesting process. And there are two things here. One is the unconditional coverage, and the second one is a conditional coverage. Under the unconditional coverage, we have a measure to accept or reject models using the tail points of a log likelihood ratio. So basically what we are doing is we are using a hypothesis test based on a test statistic. And rather than using z-test, t-test, chi-square, all the other tests, we are using a log likelihood ratio test statistic. And this log likelihood ratio, the test statistic, looks like this. Now, do we have to remember this? Not at all. For the exam, do not get into it. The calculations are not important. Understand what we are doing. So it's a method for us so that we can improve upon our type 1, type 2 errors and increase the power of test. So basically, we are running a hypothesis testing whether the model is accurate or not, where the null is it's an accurate model and the alternative, it's an inaccurate model. And this is the test statistic. I run this test statistic and I find if the test statistic is greater than the critical value, which is 3.81. So the critical value here is derived from a chi-squared, that table, chi-squared table. And it's 3.841. Remember this. Remember this thing. If the log likelihood ratio for unconditional coverage, what do I mean by unconditional? Let me just tell you. Unconditional coverage refers to the fact we are not concerned about the independence of exceptions or the timing when the exceptions occur. We are not concerned about when the exceptions happen within a year. Whether it happened in just January and nothing happened from February to December, or it just happened at the end of December, whether it was clustered or it was like every month it was happening. We are not concerned about that. We just note down the number of exceptions. We run this hypothesis and we try to predict whether the model is accurate or inaccurate. That's what we do. So if your calculated test statistic is greater than 3.841, my critical value is 3.841. If my LR falls here, unconditional, I will reject the null, which is accurate, and I will reject this thing. So what's left out is that I can conclude my model is inaccurate. I need to change it as per the QPEC method. VaR backtesting method. Make sense? That is what we have it here. Nothing major that you just have to get too much into it. Okay, what is the need for conditional coverage? We spoke about unconditional, that means no conditions at all. Whenever it happens, just note it down. Oh, do it. But there can be some other method as well, and that is known as a conditional coverage. And this framework focuses on unconditional because it ignores the conditional. So unconditional, what we do is it ignored conditioning or time variation in the data. However, remember, in reality, the exceptions can cluster, or it can form a bunch closely in time. That can be problematic. So in theory, these occurrences should be evenly spread, like monthly it should happen, it's okay. But if instead we observe 10 of these exceptions occurred over the last 2 weeks, 10 exceptions in just 2 weeks, it's a red flag. It should raise a red flag that yes, there's something problematic. So what do is you refine your hypothesis testing using unconditional coverage test statistic, plus you add some independence of the exceptions, you add to it. So what we are doing is we are adjusting this unconditional, by adding this log likelihood ratio for the independence to remove the feature of clustering, so that we want to understand whether it's very clustered or not. And so there are 2 things here that I want you to know. Okay. First thing is that if on a combined basis, this log likelihood ratio for conditional coverage combined basis, if it is greater than the critical value 5.99, so if it is, this is my critical value. Now the critical value is not 3.8, it is 5.99. So if my log likelihood ratio for conditional coverage is in the rejection region. I will reject the model and I can say that it's not accurate, it's inaccurate. And I can remove this thing. I can remove this thing and I can just calculate this individual thing to understand whether the observations are clustered or evenly spread. So I can do the hypothesis for this as well. And remember, if the independence, the log likelihood ratio on the independence, if it is greater than 3.84, 3.84 was the same critical value for the unconditional coverage, then that means we can reject. So if this thing is happening, let's say the critical value is 3.84 and my log likelihood ratio for the independence test that I'll do, test statistic, if it falls in the rejection region, then I can reject independence. I can conclude that the observations happened. It happened in a clustered manner. All the observations occurred suddenly, not evenly. And that's a big red flag. So I can do for individual, I can do it for a combined as well. Just make a note. I brought it up here in the book because I thought you can just revise through it later. Okay, what is a Basel rules for backtesting? What is a Basel rule for backtesting? Well, Basel has said that they require the market VaR be computed at 99% confidence interval when you compute the market value at risk, which is there in the operational as well, and backtested for past 1 year. So you need to backtest it for the past 1 year. That's what you have it. Calculate VaR, 99%, also backtested. These are the two things that has been mentioned. So we expect, ideally, what we do is we expect we expect to have 2.5 exceptions. That is ideally if there are 250-day trading days in a year and 1%. So 99% confidence interval VaR I'm calculating. So 1% room for error. So 1% is like 2.5 exceptions maximum. We are expecting that, okay, as per the regulator, you can exceed like 1 to 2.5, not more than that. Or let's say 3. So depending on the exceptions that you actually notice throughout the year, there's going to be some capital multiplier that's going to be added to your VaR that you, the economic capital that you keep aside. To make it more simple, when you calculate your economic capital, you calculate your VaR. But not only this, based on your back testing, there's going to be some multiplier that you need to add to this number, which is 3. So if you have exceptions like 0 to 4 observations, like within 0 to 4, then pretty much you are in the green zone and multiplier is going to be 3. That means K would be 0. So whatever your VaR is, plus 3, no K. So the multiplier will increase from 3 to 4. So it's going to be like within 3 to 4. So there are ranges. If you have 5 to 9 observations or exceptions, and if you have more than 10 exceptions, the VaR or this multiplier will be 3 plus K will be 4. So rather we can just say that it's going to be like 4. So VaR into 4 times. That is what the thing is. Okay, now how do you understand? So whenever you get understand, for a bank, economic capital is very important because you're taking money from depositors and you're giving out as loans. So you want to make sure that you just keep, a sufficient amount of capital that is needed, and the rest you can lend it out and you can earn interest out of that. That's the business model, right? So when I talk about multipliers, it's going to be based on the types of model errors. So basically you can have the exceptions. There's going to be 4 categories for exceptions. Why do you have exceptions? Is maybe the basic integrity of the model is lacking. The model that you made, the assumptions, incorrect inputs, everything was incorrect. So obviously the output will be faulty. So basic thing was missing in the model. Model accuracy needs improvement. The accuracy of your VaR model, that needs improvement. So intraday trading, maybe it was a very volatile day and the positions changed during the day. So the penalty should be considered. Now, in all these three scenarios, when the basic integrity of the model was not sufficient because of incorrect data errors, penalty Basel will apply. Model was not accurate, penalty should apply. Intraday trading losses, penalty should be considered. It's going to be considered. And what if you had an exception just because of bad luck? Maybe markets were particularly volatile or golden. Now, these exceptions should be expected to occur at least some of the time. So it's going to be considered about the penalty. It's a bad luck, but can't help it. So all in all, you just need to remember this last statement as well. Reducing the confidence interval reduces the probability of type 2 errors. Obviously, as I said, when you have a confidence interval less, there's a higher chance of rejecting the inaccurate model. And if you reject inaccurate, your type 2 error comes down. Also, using longer backtesting period can help here. Like when you're trying to note down the exceptions, you can use longer backtesting period as well. Because maybe in a month, there could be a possibility that there is no exceptions. But possibly the next month, all the exceptions occurred. So having a long horizon will really help you out. So that is what we have it here for this particular chapter. Anything you have any questions, feel free to ask.